They say that more than 90% of people don't make any trading and just give up. And personally, after losing and blowing accounts for 2.5 years, since then I have made multiple six figures. When I first started, I was completely lost. I didn't have guidance and I needed to build my own strategy from zero and then scale it to $20,000-$30,000 a month. So my goal is that by the end of this video, you will know exactly how I did this. You will know the exact strategy and all the systems that I have used. So if you are serious, don't skip anything. So let's get into it. So let's start with the first and the most important thing that you have to understand in trading. And what is that going to be? That is going to be the risk to reward. So basically, what does that mean? That means, for example, for this trade, for example, that you enter right here, of course, on the entry line, and then what happens? You have to adjust the risk. So for example, if your trade was to lose right here, you would lose $1,000. Then of course, at 1-to-1 risk to reward, we are going to make $1,000 because of course it is exact distance from the entry to the stop loss and then entry to the take profit. So it is 1-to-1 risk to reward. Then we have a 1-to-2 risk to reward, which we are going to just call 2R. So basically, what is that? Is if we are risking $1,000, we are going to lose $1,000. But if we win the trade, we are going to make $2,000. Then we have the 3 risk to reward, which is going to be if we risk 1,000, we are going to make $3,000. And why is this so important? Because in trading we have this. So basically trading is all about statistics and the win rate and of course the numbers. So for example, if you are going to target 1-to-1 in trading, we cannot have a 40% win rate or a 30% win rate because we are not going to be profitable. If we are going to target 1-to-1, so risk 1,000, make 1,000, we want to at least have more than 50% win rate. So for us to actually be profitable in the market, we need to have a 60% win rate or more to actually be profitable in the market. So at 50% win rate, we are going to be break even. So basically we are not going to make anything and we are not going to lose anything because it is 50% that we are going to lose or win the same amount. Then for example, 1-to-2 risk to reward, which is really good to target in the markets because it's not huge and we can also have huge win rates with it. Basically, we need only 40% win rate to actually be profitable in the market. And then of course, 1-to-3 risk to reward, we can even have 30% win rate and we will be slightly profitable. So basically, as the win rate goes up, we do not need such a huge win rate to be profitable. And of course, it is harder to have a bigger win rate with a bigger risk to reward. So of course, I think that you should find a sweet spot around 1-to-2 risk to reward and basically get an edge on the model where you can actually be profitable. So basically, I'm going to learn you a simple model, nothing complicated, because in trading, actually simplicity equals profitability. So we do not want complex stuff. So I'm going to teach you a rule-based model that is going to be easy to follow and to execute. Then of course it's going to be repeatable, so it's going to happen every other day or even every day, and of course it is actually proven to work. Then also another thing, we are only going to trade for 60 minutes a day because we want to use trading as a tool for the freedom. We do not want to 9 to 5 the charts because then trading doesn't make any sense. We can just go get a regular job. And also before we get into the strategy, I just want to show you results for this ongoing month. So you can see right here, I've had some winners, I've had some losers, but right now month is still going pretty good. And of course, I'm looking forward to maybe take 1 or 2 more wins so I can finish the month really good in green. So right now we can actually get to the strategy. So what the strategy is going to be about, it is going to be about SCM. So basically we are going to have 3 steps in the strategy. So let's start with the first step, which is going to be structure. So in market, we first want to identify where the market is headed. And how are we going to do that? We are going to do that by simply seeing where the structure is getting created towards you. So for example, in the market, we are always going to see a pushes to either upside or to the downside, which is just going to prove to us where the market is actually dominating towards to and where does it want to go. So in this example, you can see right here, we have the pushes to the upside and basically not that big pushes to the downside. So what does that mean? That means that market actually wants to push to the upside. So this is going to be our structure where we just kind of see where the market actually is headed towards to. After that, what we are going to have is we are going to have pullbacks in the market. So right here you can see we made a pullback right here, then we also made a little pullback right here. So why are those corrections really important to us? Because market cannot just pump forever like this, because sometimes it actually got to make a correction like this so that it can of course continue pumping or either dumping to the downside. So this is going to be really important to us, because what we want to do is in the step number 2 is we want to identify the key liquidity levels. And that maybe sounds complicated, but the point is the key liquidity level is actually going to be the low of the correction leg. So after we see a push in the market and followed by that we see a correction in the market, all we want to do is we want to see and we want to draw a low of that correction leg. So that is going to be a pretty obvious low in the market. I'm going to show you later tricks to actually spot it and how to mark it out. So basically till now we have our structure leg and then we have our correction leg, and we marked out the low of the correction, which is a key liquidity level. So the next step is going to be a step number 3, and it is going to be to wait for the liquidity grab and of course an entry model. So the first thing you can see right here, we have a correction slow, and of course it got manipulated right here. So basically after that manipulation, which the logic behind it is really smart, because for example if the market is pumping and we make a correction, a lot of people are going to start buying into the market if we start going to the upside. But then what the market makers, banks and institutions do, they really like to do those manipulations where we actually sweep that correction low one more time and basically stop out all the stop losses from that recent low, from all the people longing the market and longing the uptrend, and then we are going to actually continue going that direction after we actually manipulate the correction slow. And you've probably seen this a lot of the times in the market. We are uptrending, you enter a position, you get manipulated, and then the market actually goes your direction. And that is just the whole logic of it, because you did not wait for that manipulation leg, or you basically wait for the market to stop everyone out. So after we have our manipulation like this, and basically after we sweep the correction slow, what we need to do is we need to look for the entry model. And the entry model is going to be on the lower time frame. So basically I'm going to show you all the time frames later, but it's going to be on the lower time frame, and all it is going to be is a inversion of the fair value gap. So you can see right here a liquidity sweep of a correction slow, then we have a fair value gap right here, which is a 3 candle formation. You can see from the first candle wick to the third candle wick, there is a hole in the market like this. So basically you can see from this wick to this wick, it's a hole and it is an imbalance or a fair value gap. How do we want to see it inversed? Basically, we want to see a closure above that fair value gap. So in this example, you can see that this is a bearish fair value gap. So a fair value gap that was created while we were going towards the downside, which means it's a bearish one. So that means that we want to disrespect it and of course close above it. So basically we want to close with a body. So this is the body of this candle. We want to make a closure above that fair value gap, and when we get the closure, all we do is we actually enter the market. What we do is we put our stop loss below, and of course we enter on the closure of that candle, and what we do, we target to the upside to of course make a new structure. I'm gonna learn you how to target the exact liquidity that is really most likely to get swept, so you can actually get the biggest risk to reward in trading. So of course that you don't need such a huge win rate to be profitable, but of course I'm going to teach you even how to have a huge win rate and how to target a big risk to reward, so you are totally completely safe. But one really important thing around this model is that we are not always going to have those perfect conditions. So we need to understand where we have a trending opportunity, basically where we are making a uptrend so we can continue the uptrend, and where we can actually reverse the market and target to, for example, the downside. So right here we have a simple concept of candles. So you can see right here, this is just a strong candle to the upside, which is indicating to us that the market is really likely to of course continue that direction to the upside, because the volume towards the upside is pretty big. Then we have a red candle right here that is really powerful to the downside with small wicks. So market is really likely going to continue towards the downside and make new lows. But then on the right whatsoever, we have something completely different. We have a candle that rejected really hard from one direction. For example, this candle really tried to go to the downside, since you can see a huge wick. So market opened right here on the body. We tried to go down, but market ended up completely rejecting it and closing back up here, which means we tried to go to the downside, but then buyers took the control of the market, pushed it back up, which means this is really likely a bullish reversal and we are really likely to go to the upside. Then we have the same scenario right here. The buyers try to push the market up, but then the sellers came in the game and completely pushed the market to the downside, rejected it, and basically we are really likely going to continue going down. So this right here is the main difference how you are actually going to execute this model. So on the left, we have a pretty clean trending market to the upside. You can see right here the correction, the manipulation, and then of course the structure to the upside. But if we do not have this exact picture in the market, what you are going to do is you are actually going to use the same model but in a different way. So right here you can see that this market, for example, is not going either to the upside or to the downside. It is just consolidating in the same place. So when we have something like this in the market, we are going to use a different approach, and that is going to be the first step to mark out key liquidity levels. So right now we learned that the key liquidity level was a corrections low or a corrections high. But in this example, what a key liquidity level is of a consolidation phase, so this is a consolidation phase, it is going to be a biggest high in the market. So it is going to be this high right here because it is the biggest, and it is going to be the biggest low in the market. So of course that is this one right here. So what we need to do in the market is we need to mark those two out. So there is no structure, there is no correction, but we want to mark out a range of what the biggest high was and what the lowest low was in the market. When we do that, all we want to do is we want to wait for the manipulation of the one side. So market can either choose to manipulate the downside or market can choose to manipulate the upside. So in this example, we manipulated the upside. And now this is where the most traders get it wrong, which is exact reason why they lose in the market. Because when they see a strong push to the upside, of course, taking this high, what they are expecting to see in the market is some kind of breakout to the upside, which is of course not logical at all, because what is happening in the market is manipulations and basically just sweeping people out. So market makers pushed the market to the upside so they can sweep all of the stop losses from the biggest high, and then followed by that, what they actually want to do is they want to target the rest of the stop losses towards the downside. So basically a manipulation towards the upside, we want to see a reversal. And if we got a manipulation towards the downside, we want to see a reversal to the upside, targeting the rest of the stop losses. So right here, you can see manipulation to the upside, and then we still have the same entry model. So we have a fair value gap, so 3 candles right here, you can see the hole in the market, and then basically we closed below it. So what we do is we enter the market on the closure and we wait for the trade to play out. And you can see right here, we basically swept this high right here. And then what we targeted in the end was this lowest low in the market. And it was the lowest low of this consolidation phase right here. So you can see how it worked beautifully. And basically I showed you the monthly PNL, but this is my win rate over the course of a year. So you can see right here, I made just over $300,000 in a year with this model, and I have just under 80% win rate. Of course, win rate can completely vary dependent on how big the risk reward is that you are actually catching. And now a lot of people are wondering, when they have the actual knowledge, the strategy, so for example when they have this strategy that they can actually implement and trade, how to actually scale and how to use propfirms. So basically the propfirms are going to be a tool that is going to be really helpful for us to scale. So the skill is going to give you access to capital, because in trading you do not need capital to start trading. You actually need the knowledge and the skill, and then you will easily get access to the propfirms and basically get money to trade. So the steps are going to be that you pass a trading evaluation. Of course, I'm going to leave some links down there in the description and some discount codes if you of course want to get a propfirm challenge. The next step is going to be that you get an access to of course a funded account. So when you get to this point, you already have money to trade. And of course the last step is you basically trade that funded account and you get to keep more than 80% of your profit. So this is of course completely up to the propfirm. Some allow 80%, some allow 90%, and some even allow like 95%. So basically almost everything that you make is going straight into your pocket. And now a lot of people are wondering how are they going to scale? Because if you buy one account, of course you can just make the money from it. You cannot size up because then you can easily lose the account. So for example, if we have a one propfirm account and we take 3 wins, so that is in total, let's say a $500 a win, that is going to be $1,500. So of course this is not easy to do at all. Even with a one account, this can of course take a really long period of time and a lot of dedication in the markets. So let's just say that for example you take 3 wins, you make $1,500. So basically that is really good, but that is actually nothing special if you want to make huge money. And then how you're actually going to scale in trading is if you scale with multiple accounts. So one propfirm account right here is gonna be $1,500, but then here we have 20 propfirm accounts. And then if we risk $500 with each account, so times 20, each win is going to be $10,000. And then 3 wins, so basically only 3 wins are going to be $30,000. So you can see how huge we can actually scale. And of course, not only to mention that you can have way more than 20 propfirm accounts. And of course, I'm gonna leave a trade copier down there in the description, and there is also gonna be a discount code, so you can basically use it to copy instantaneously a lot of the accounts like this, and you can scale your trading game. So right now let's get to the actual chart examples. Okay, so here we are in the live example in the market. So the first thing that we need to actually notice in the market is where the market is right now headed to. So we can easily spot that it's headed to the upside. So basically right here you can see that we have a structure to the upside, then we had a correction, and then after that you can see like we made a pullback and a manipulation of this low. After that we made a huge structure, and then we made a correction, and of course right now we are expecting another manipulation of this low. So if you want to mark out how that actually looks, is this right here is going to be our actual structure. We can mark it with yellow, then we have a correction right here that we can mark with, let's say, purple, and then right now what we are expecting to see in the market is gonna be the actual manipulation, which is going to be to take out this low in the market. So let's right now scale down to the lower time frame and actually wait for this manipulation to happen. And also what we can do is we can mark out the new biggest high that we can later on target if we get an entry towards the upside. So basically right here you can see it is exactly 9:30, so market is right about to open. So you can see right here market just got huge volume. Of course it is at the moment dumping, so let's see if we are actually gonna get the sweep of this low. So right now market is getting close to it, and there it is. So basically right now what we want to see is a disrespect of the last fair value gap in the market. So you can see right here, this is the last fair value gap in the market, and we want to see a closure above that fair value gap. So at the moment looks like we are slowly going towards it. So this is not a closure above, and then this is just a wick above, not a closure, and this is our actual closure to the upside. So what we do is we enter the market, we put our stop loss below like this, so below the candle or below the body, but I always like to give some space. And basically what we do is we target towards the upside, towards that high that we actually talked about. So now all that we do is we enter the position, and then we wait if the take profit is gonna get hit. And then right here you can see in less than an hour we got a nice 2.2 risk to reward trade. Okay, so here we are at the second example, and this time in the market it's something different. We are not uptrending in the market, or we are not downtrending in the market. We are actually just sitting in this box right here. So you can see that the market is actually making a push to the upside, then a push to the downside, then a push to the upside, downside. So basically what the market is doing, market is just consolidating. So what we are going to do is we are going to mark out our highs and our lows. So right here, the market, I would say, started to range, and this is looking really clean. So what we are going to do is we are going to mark out the low of the consolidation, and we can also mark out the high of the consolidation right here. And then basically all we are going to look for is for that manipulation to happen. So right now what we are looking for is either the upside to get manipulated or either the downside to get manipulated. Followed by that, we want to see a reversal in the market. So if we scale down in the market, of course, to wait for that sweep, let's see, we have a high and our low right here. What is going to get manipulated first? We can see 9:30, so market open just happened. So let's see. Looks like we are going for the downside, and is that going to be the case? And so there it is. So basically right now, all we want to see is the last fair value gap in the market to get disrespected. So we have a fair value gap right here. But there is a catch with this position. So you can see that we have a fair value gap right here, but then we also have a fair value gap that is right above it. So for example, if we tap into this fair value gap, we also want to see that one get disrespected because it can easily reject the market. So let's see if the both fair value gaps are going to get disrespected. So now we disrespected this fair value gap right here, but we still want to see this fair value gap getting disrespected because we haven't closed above it. So looks like right now we just rejected from that fair value gap. And let's see, so in the end we ended up rejecting. So if you entered this position right here, it would have been a really fast loss because we actually haven't disrespected the second one that we tapped into. So right now what we have actually had and seen just happen is we got another sweep, so another manipulation because we haven't got the entry model. And right here you can see that we have a fair value gap right here, and what we have done is we have inversed it to the upside and disrespected it. So what do? We enter the market right here. We can put our stop loss below the body, below the candle. It does not really matter. And what do? We actually target to, of course, the upside, and basically let's see, our risk to reward is just bigger than 3 risk to reward. So if we target this high right here, we can basically have a 30% win rate and we are still going to be profitable. So if I fast forward the market, let's see if it's going to play out, and there it is. So we avoided the loss right here. That was not good at all, and it would have only been 1 risk to reward, and of course it wasn't a good trade. And then we got a perfect entry right here for just above 3 risk to reward. Alright, so I hope that you liked the video, but before you leave the video, just make sure to subscribe to the channel and like the video, and of course comment any questions that you have. And also one more thing is, if you maybe want to get to work one-on-one with me, there is going to be a link down there in the description for you to actually apply. And of course if you get accepted, you may get to work with me one-on-one. So of course spots are limited, so don't wait on it because you can miss it completely. And yeah, basically with all of that being said, I hope that you enjoyed the video and learned something, and I'm going to see you in the next one. Peace.